Welcome to Breaking News to Trading Moves. We're starting today with a pretty notable government action, one that's already having effects across the automotive supply chain, particularly, it seems, in the premium car market.
That's right. We're talking about the UK government stepping in to back Jaguar Land Rover, JLR, They've put up a $2 billion loan guarantee, and this is being handled through UK Export Finance.
Okay, and the backstory here is important. JLR, obviously a major premium car maker, they had a real problem. Production just stopped for nearly a month, is that right?
Yeah, almost a month. And the reason? A cyber attack, which frankly tells you a lot about the vulnerabilities in modern manufacturing.
So a month offline creates huge problems, especially for suppliers, I imagine. So this guarantee, the idea is to stabilize things.
Exactly. It's not just about JLR itself. It's about restoring some stability to that whole network of companies that supply them. So our task here is to look at what happens next. What are the market movements? We want to identify who stands to gain from this government-backed recovery, the winners, you could say, and just as crucially, which companies might face new challenges or more competition because of this. The losers, perhaps.
Right. So let's get into the mechanics first. $2 billion is obviously a lot of money, but it's a guarantee, not just a loan. It comes via UK Export Finance, UKEF. What's the immediate goal here? How does a guarantee work differently than, say, just giving JLR the cash?
Yeah, that's a key difference. The main point of the guarantee is to get liquidity flowing, but not directly into JLR's bank account necessarily. It's aimed at their suppliers, their whole network of Tier 1 and Tier 2 companies. You see, a direct loan adds $2 billion straight onto JLR's debt load. That could affect their credit rating, future borrowing.
Okay, so the guarantee is a less direct approach.
It's more like a safety net. UKEF is basically saying, if JLR can't pay its suppliers or banks for specific things, we'll cover it. That promise instantly makes JLR's debts less risky. Think about their accounts payable, the money they owe suppliers. If you're a supplier who hasn't been paid for 30 days because of the shutdown, suddenly JLR's promise to pay looks much safer because it's backed by the government. So the supplier's bank is more willing to lend them money against those JLR invoices. It unlocks cash for the supplier based on JLR's now guaranteed creditworthiness.
Ah, I see. So it's about restoring confidence in JLR's ability to pay its bills, which then gets cash flowing to the suppliers. But let's not forget why this was needed, the cyber attack. What exactly happened operationally? Why did it break the supply chain so badly?
Well, it wasn't just a simple glitch. It seems to have hit their core manufacturing IT systems, specifically the systems they use to order components, the highly customized parts. That's the logistical heart. JLR, like a lot of premium car makers, they rely heavily on just-in-time JIT delivery, especially for big things like seats, dashboards. When that IT system goes dark, JIT just falls apart. Suppliers literally don't get the message about what specific part to build or ship next, what color leather, which wiring setup.
Right. Chaos. So the guarantee is the financial fix, and the goal is to get the factories humming again. What's the target number JLR is trying to hit?
The main operational goal is restarting vehicle production, obviously, and getting supplier output steady again. Publicly, they're aiming to ramp back up to about 1,000 cars per day across their UK plants. That number, 1,000 cars a day, that's kind of the benchmark to watch. If they hit that consistently, it means the supply chain is working, the IT is fixed, and the guarantee is doing its job.
Okay. A month-long halt from a company like JLR must have sent shivers through the supply chain. How does this specific action by the UK government help stabilize what is really a global network of suppliers?
It effectively creates a priority lane. For suppliers, having that UKEF guarantee behind JLR's orders makes those orders the safest ones on their books. Think about payment terms, usually 60, maybe 90 days in auto. After a shutdown like that, suppliers start worrying if they'll ever see that money. With the guarantee, they know they'll get paid. So JLR orders suddenly look very attractive, very low risk. This lets smaller suppliers, especially the ones operating on tighter margins, restart their lines, buy materials, commit resources again.
But that stability for JLR and its suppliers, it doesn't happen in a vacuum, right? If JLR is back online, demanding parts, and armed with this government-backed credit, what does that mean for the rest of the auto industry?
Well, it immediately impacts the allocation of scarce resources, chips, certain high-end materials. Demand for premium Range Rovers and Jaguars that was just gone for a month is now back. And it's back with force, backed by this guarantee. This means other car makers, other OEMs, might have to compete harder for those same limited components, particularly the high-value ones used in premium cars. It temporarily gives JLR more pull in the market for those parts, and that has consequences for everyone else.
Okay, that sets up the next part perfectly. Let's talk about the companies who feel this effect first, the beneficiaries. We should start with the big players, the Tier 1 auto suppliers. They're right at the front line. Why does this guaranteed financing give them such a direct lift?
It really comes down to working capital and risk. When JLR stopped production, orders dried up, but the Tier 1s still had costs, payroll, keeping the lights on, inventory just sitting there. And the big worry was the money JLR already owed them, their accounts receivable. If JLR had serious financial trouble, that cash, which can be a big chunk of a supplier's annual revenue, might just disappear.
Ah, so the guarantee isn't just about future business, it makes the existing debt safer too.
Exactly. It basically de-risks those outstanding payments. It cleans up that part of their balance sheet, you could say. So these big suppliers can now expect better volumes, obviously, but also faster cash conversion. They move from worrying about collecting old debts to confidently planning for new production. Getting that cash in the door sooner makes a big difference to their financial health, almost immediately.
Okay, which specific companies are well positioned here? The ones with strong links to JLR's European operations.
Yes, we'd look at major diversified suppliers who are deeply integrated into those premium vehicle programs in Europe. Magna International, for example, ticker MGA. They supply complex vehicle modules globally. And Lear Corporation, ticker LEA. Lear is interesting because, as we'll get into, they have exposure in a couple of key areas here.
All right, let's drill down into one of those areas. Seating and interior specialists. You mentioned a premium pull-through effect. Why do these companies get a particular boost when luxury production restarts?
It's really about logistics and the type of product. Seats are, believe it or not, one of the trickiest components. They're bulky, they're incredibly customized. Think about all the options on a high-end Range Rover for leather, stitching, cooling, heating, massage functions, and they absolutely have to be delivered just in time, often assembled very close to the JLR factory. A shutdown creates a massive logistical jam for these guys.
So when production restarts, JLR needs to prioritize getting the most profitable vehicles out the door first.
Right.
And those tend to have the fanciest interiors.
That's exactly it. To hit that 1,000 car day goal efficiently, they'll focus on the highest value vehicles first. That means they need the high-end interiors, the complex seats, the premium trim, the advanced dashboards, the soundproofing materials. So for these suppliers, the restart isn't just volume coming back, it's high-margin volume coming back first. Their product mix immediately looks better, supporting higher average selling prices and better margins for them.
Which companies are key players in this specific area?
Lear Corporation, ticker LEA, definitely comes to mind again. They're strong in high-value interiors and the related electronic systems, especially for European luxury cars. And we should also mention Adient PL, ticker ADNT. They're one of the world's biggest automotive seating suppliers. They're very well placed to benefit quickly as JLR ramps up production of those premium models.
Okay, moving on to another critical area. Auto semiconductors and AS components. That's advanced driver assistance systems. How does the JLR guarantee change things for the chip makers?
For chip companies, the guarantee translates into something very valuable: reliable demand visibility. The semiconductor world runs on long lead times. They need stable, predictable orders to run their fabrication plants efficiently. Suddenly, JLR, backed by this government guarantee, looks like a very reliable customer again. The market trusts that JLR will need these chips to hit that 1,000 car target day after day.
That certainty must be gold, especially after the recent years of chip shortages and unpredictability.
Absolutely. And we're not talking about basic chips here. We're talking about the high-value ones essential for premium vehicles. Things like sophisticated power management chips, high-speed connectivity modules for the big screens and infotainment systems, and crucially, the processors for ADAS features, the sensors, radar, LiDAR processing, all the things that make a luxury SUV feel premium and safe. JLR needs a steady supply of these specific high-margin chips.
So what does this renewed reliable demand do for the chip manufacturers themselves?
Well, it helps them work through their order backlogs faster. Chips that were ordered but just stuck during the shutdown can now ship. Inventory turns into revenue. This return to a more predictable flow helps support pricing for these specialized auto chips. It improves utilization rates at their fabs, and fundamentally, it brings back a stable, high-margin customer in that premium auto segment.
Which chip makers stand out here?
You look at NXP Semiconductors ND, ticker NXPI. They're a major automotive semiconductor supplier, particularly strong in connectivity and in-vehicle networks. And also Mobileye Global Inc. ticker MBLY. They are a leader in ADS technology. Their vision systems, the cameras and processing, are key components in the advanced safety features that are standard on JLR's vehicles.
Okay, so we've painted a picture of improved certainty and financial upside for JLR's direct suppliers and component makers. But now we need to look at the other side of the coin. This stabilization for JLR might create friction elsewhere. Let's start with U.S. mass-market OEMs, the big American car companies.
Right, this is where you see how a decision seemingly focused on the UK can have ripple effects, or rather, knock-on effects internationally. The UK government guarantee, by making JLR a safer bet for suppliers, effectively bumps JLR up in the queue for shared components.
Wait a minute, so shared components, parts that both JLR and, say, Ford might use.
Sure.
Isn't the UK government basically subsidizing JLR's access to these parts, potentially at the expense of U.S. companies, even though JLR is owned by Tata, an Indian company?
That's the tension, exactly. The stated goal is UK jobs, UK manufacturing base. But the mechanism, the guarantee, has global consequences. It shifts the allocation priority for parts where supply might be tight. Things like certain electronic control units, wiring harnesses, maybe even some types of infotainment screens that suppliers like Magna or Lear might provide to multiple car makers. Now, those suppliers might prioritize the guaranteed JLR orders, which are also likely high-margin premium parts, over orders from U.S. mass-market producers.
And what does that mean in practical terms for companies like General Motors or Ford?
It could mean operational headwinds. Scheduling problems. They might not suddenly be unable to get parts, but they could face tighter availability, longer waits for key shared modules. And if a Tier 1 supplier is diverting capacity to JLR's guaranteed programs, GM and Ford might have to adjust their own production schedules. Or, and this is key, they might have to compromise on their vehicle mix.
Compromise how? What would that look like?
Well, if they're short on a specific chip or module needed for a high-end truck or SUV, they might have to build fewer of those really profitable vehicles. They might shift production to lower spec models that don't need those specific now constrained parts. That directly hits their revenue per vehicle sold.
Which U.S. mass-market companies are most likely to feel this pressure?
General Motors, ticker GM, certainly could face some constraints and mix pressures if key suppliers redirect capacity towards European luxury production. Ford Motor Company, ticker F, is similarly in the mix. They rely on a global supply base for components used across many platforms, so any tightening in that shared base could affect their high-volume vehicle production.
Okay, let's shift focus to the competitive dynamics in the showroom. What about luxury electric vehicle challengers? Why does JLR getting back on its feet pose a challenge to the newer EV companies?
It's about normalizing the competitive landscape, especially at the high end, particularly in the SUV space. Think about it. When JLR was offline, if you wanted a large premium SUV for, say, $90,000 or $100,000, your choices were artificially limited. That potentially pushed some buyers towards high-end EV options from Tesla or Lucid, maybe sooner than they otherwise might have considered.
Right, but now the Range Rovers and Jaguars, including their hybrid models, are coming back onto the market.
Exactly. You've got restored competition from established luxury brands. The Range Rover especially has a certain status, a specific appeal luxury capability that directly competes with high-end electric SUVs. Buyers who might value that established brand or maybe weren't quite ready for full electric but lacked traditional luxury options temporarily now have those choices again. That erodes the sort of temporary advantage the pure EV players might have had due to JLR's absence.
And what's the likely financial impact on those EV competitors?
It puts pressure on their order books and potentially their pricing power. Tesla, for instance, has done well selling the Model Y and Model X into that premium utility space, partly helped by supply issues at traditional competitors. Now, with Range Rovers and other JLR models reappearing in dealerships, that competitive space gets tighter. It might make it harder for the EV companies to hold firm on premium pricing without maybe offering more incentives or deals.
So which luxury EV makers are most directly affected by this renewed competition?
Tesla, Inc., ticker TSLA, definitely faces more direct competition now, especially for buyers considering high-end SUVs. The return of JLR's luxury lineup is a direct counterweight in that price segment. Also, Lucid Group, Inc., ticker LCID. As a company still working to establish itself in the high-end luxury EV market, the return of strong, established competitors like JLR just makes that task a bit harder. More choices for the consumer usually means more pressure on the newer entrants.
Okay, one final category, facing potential headwinds. The aftermarket parts retailers. This feels like a more indirect link. Why would JLR restarting production affect sales of things like, oil filters or brake pads at retail stores?
Yeah, it's definitely indirect. It works through the used car market and consumer behavior. During times when new cars are hard to get, like during the chip shortage, which was made worse by things like the JLR shutdown, the price of used cars goes way up.
And when used cars are expensive, people tend to hang on to their older cars longer and fix them up.
Exactly that. High used car prices, plus the difficulty of even finding a new car you want, encourages people to invest more in repairing their current vehicle. We call it increased DIY do-it-yourself repair intensity. Maybe they'll pay for that big transmission repair on their 10-year-old car because buying a replacement, new or used, is just too expensive or too much hassle.
Okay, so JLR restarting production helps ease the supply tightness, at least at the premium end, which contributes to the overall market normalizing somewhat. When new car availability improves even a bit, what tends to happen to used car prices?
They tend to soften. Used car inflation eases off. As new cars become more available and maybe slightly less expensive, the pressure to keep that really old car running diminishes. People become a little more willing to trade up or replace their vehicle. That, in turn, creates a bit of a headwind for those aftermarket retailers who benefited so much from that intense DIY repair trend. It's a gradual shift, but market sentiment often reacts quickly to signs of production stabilizing anywhere.
Which retailers are most exposed to this potential easing of repair intensity?
Companies like AutoZone, Inc., ticker AZO, and O'Reilly Automotive, Inc., ticker ORLY. These guys had a really strong run during the pandemic and the subsequent supply chain chaos. They benefited hugely from people fixing older cars. Now, as the market slowly normalizes and JLR coming back online as part of that normalization, they face the other side of that trend.
All right, we've covered a lot of ground, mapping out the effects of this JLR guarantee. For listeners trying to track these market movements, let's try to summarize the positioning. Where does the analysis suggest potential opportunity, and where might caution be warranted?
Okay, based on the factors we discussed, the de-risking for suppliers, the focus on premium components, the areas that look potentially favorable, sort of a long bias, remains centered on those Tier 1 suppliers closely tied to European premium vehicle production. So again, Magna International, MGA, Lear Corporation, LEA, and Adient PLC ADNT. And alongside them, the auto semiconductor companies with heavy exposure to high-end features, NXP Semiconductors, NXPI, and Mobileye Global MBLY.
And on the flip side, where does the analysis suggest potential headwinds or maybe a need for hedging?
The focus there would be on the mass market OEMs who might face that parts allocation squeeze we talked about. So General Motors, GM, and Ford, F. Also, keeping an eye on certain luxury EV names makes sense, especially if the supply of competing premium gasoline and hybrid vehicles from JLR normalizes quickly. That points towards Tesla, TSLA, and Lucid Group, LCID, feeling that renewed competitive heat.
Now, this recovery for JLR isn't just a one-day event, it's a process. What specific things should people be watching to see how effectively this guarantee is working and how JLR's recovery is actually progressing?
Yeah, there are probably 5 key things to track. First, look for the formal details of the UK Export Finance Guarantee, the specific terms and conditions, the duration, any metrics tied to it that will tell us more about the government's expectations and commitment.
Okay, second, operational reality.
Exactly, the actual pace of the JLR plant restart. Are they consistently hitting that 1,000 car a day target? We need to see sustained production. Tied to this is the third point, evidence of timely supplier payments. Are suppliers actually getting their money faster? This should eventually show up in the supplier's own financial reports as improved working capital.
Makes sense. And the last two are more forward-looking.
Yes. Fourth, watch JLR's announced build schedules for the coming months, say October and November. That gives the market visibility into their planned volumes, indicating if they think the disruption is truly behind them. And finally, fifth, keep an eye on dealer inventory levels for premium vehicles, especially in the big US and UK markets. If inventories of high-end SUVs start building up quickly, that's a sign that competitive pressure on the EV makers is really ramping up.
This has been a fascinating look at how one specific event, a government guarantee following a cyber attack, can quickly alter the landscape for many companies across the globe. It creates security for some, particularly those making premium parts, but it also introduces new pressures for others, whether they're competing for those same parts or for the same high-end customers.
It really underscores that in today's tight supply chains, certainty, especially certainty of payment backed by a government, becomes incredibly valuable. It directly influences how resources get allocated.
So as we wrap up, maybe one final thought for everyone listening. If a major cyber attack on a manufacturer can lead to this kind of government financial intervention, does this set a precedent? Could we start seeing supply chain disruptions treated more like national security issues, potentially warranting state backing more often in the future? Something to think about. Please remember, this presentation is not financial advice, nor is it a recommendation to buy or sell any security. This discussion is purely the opinion of the author of the material presented.